Welcome to the BNB Investing Podcast for real estate investors. Fix and flippers and realtors exploring investment options with Airbnbs and short-term rentals through acquisition, leasing, or management to generate consistent monthly revenue. Join us for a chat with experienced and successful short-term rental investors to hear their story of how they got started and created wealth by building scalable businesses. We also explore various service providers and lenders that help make our businesses more efficient and maximize revenue in this awesome sharing economy. Welcome your host, Rich Munroe.
Hey everyone, here with BNB Investing Group. Thanks for jumping on this week with BNB Investing. As a reminder, we help investors navigate the short-term rental model, whether you're doing acquisitions, management, or master leasing. It's my pleasure this week. I'm kind of excited. We've got a good friend of mine, Bram, on with AirDNA. We're going to be digging into the data in terms of what's going on in each market. And in particular, we're going to kind of focus on Atlanta. We have a lot of our members that are in Atlanta. But Bram, thanks so much for jumping on this week with me. Give us a brief background on you, and then we'll kind of jump in.
Great. Yeah. Thanks, Rich. I came on the program about a quarter ago, and we had some good expectations for it. So I'm really excited to get into the data. I'm the Director of Economics and Forecasting at AirDNA. We scrape the web for Airbnb listings, also VRBO, Expedia. So we try to capture the entirety of the short-term rental market as best we can, and we can get very granular data too. So today, like you said, I'm going to be looking at the Atlanta market as a whole, but also relating it to the whole U.S. market as well.
Awesome, very cool. And I mean, I think in general, a lot of us that have been in short-term rentals for some time have definitely, especially in the last year and a half, experienced a little bit of a downturn in occupancy levels and ADRs. And I had Jamie on a few quarters before the last time you were here. And at that time, I think we were looking at data from last year that kind of was the first representation of supply slightly outpacing demand, and just enough really to start impacting a lot of markets in terms of, lower activity in the short-term rental market. And so I'd love for you to comment just kind of, what's just in general, what you guys have been seeing as well over the last several years.
Oh, yeah, absolutely. So, of course, 2021 was a gangbusters year for short-term rental. We're all coming out of the pandemic. Everybody was desperate to get out, and the hotels weren't open yet. So short-term rentals were doing really well. We got occupancies way up, in fact, higher than they've ever been. But as you said, since then, the occupancy has been sort of ratcheting down from those 2021 highs. And then last year, what we hoped would happen is that we would settle into sort of a long-run kind of stable equilibrium, as the economists and me likes to say. But we did see supply continue to outpace demand, and we actually dipped a little bit below 2019 level performance on a per unit basis. So that was, it was difficult. It was a tough year, 2023, for a lot of short-term rental operators. You saw that bottom line shrink a bit. There was a lot of competition in this space. At the same time, inflation was very high in 2022, and then it was still pretty high at the beginning of 23 as well. And I recall too that every single quarter, we were all of us economists, we were predicting recession every single quarter. We're saying it's just right around the corner. So everybody was clenched up tight, and they were trying to save all their pennies where they could. So I think we had some demand trouble as well. But, what we've been seeing this year in 2024 is, after maybe a rocky kind of start at the beginning of the year, things are starting to loosen up a little bit, and we're finally seeing improvements to that per unit performance, which are desperately needed for a lot of folks.
Totally agree. Absolutely. And so there's a little bit of a glimmers of hope, and we should dig right in. I know you've got a presentation prepared, so we can kind of look at some of these historical data points and really kind of just dig right in.
Sure, yeah, and I've got a lot of graphs, but I like to try to tell a story with the graphs wherever I can. But if you've got something that sparks your interest, then please feel free, Rich, chime right in. But this is what we were talking about earlier: is that supply. This is the whole U.S., and you can see that supply dipped right during the pandemic, but it started to bounce back. And it started to accelerate very, very quickly. Interest rates were very, very low. We cut interest rates to stimulate the economy in the worst parts of the pandemic, and housing was very cheap, and short-term rentals were very profitable. So a lot of people made a very simple calculation to try to get into this business. And you can see that here with that supply increasing. That green dotted line, that's sort of the pre-pandemic the pre-pandemic trend, and we're sort of trying to get back up there in the US, and you can see we almost sort of made it. However, in 2024 we're starting to put a little bit more daylight between that solid blue line and the dotted green line. Now, Atlanta is not a microcosm of the country as a whole. We've actually seen investment and development in the short-term rental space kind of stifled in Atlanta, and we were talking about this before we started the webinar, Rich. But there's certainly the sort of regulatory environment. It's not necessarily restrictive, per se, but it is uncertain. And that lack of certainty is, that's the worst for investment. Nobody wants to get into a market if they don't know what the rules are, if they don't know if they're going to be changing tomorrow. And you can see that really easily here in the supply. It's been pretty stagnant since about 2022. We haven't made any headway. In fact, we're losing a lot of ground from the pre-pandemic trend. And we even started to see demand diminish going into March and May, which, that was upsetting for me a little bit. But luckily, in the last 3 months since we've gotten about 1,000 listings back. So we've stabilized again right around the 20,000 available listings mark. And a lot of that is lots of people staying in the market, as we'll see in just a minute, which is, I think, says a lot about the people that operate in Atlanta and their persistence. Because if you look at new listings, and supply growth, new listings have been diminishing. This is the total change in supply on a year-over-year basis. And again, this is for the entire United States. You can see where it really ramped up in 2022 in response to that amazing performance that we saw in 2021. It's been going down ever since, but it's still, when you're increasing supply at, say, 22% year-on-year basis, I mean, that's a really huge change. And it takes a long time, I think, to recover from that. And though it has been diminishing, it's been taking a while. But, we did increase interest rates. We're trying to whip inflation. In fact, it's mostly taken care of at this point. We've even cut rates at the most recent year. But those higher rates and that high mortgage, the very difficult mortgage environment that we've been in has really pinched new supply, and it has slowed supply growth as well. It's been even more severe in Atlanta because we've been hit by that double whammy in Atlanta. We not only have high interest rates, but Rich, I don't know if you've tried to buy a house in Atlanta lately, but the prices are incredibly high.
Right.
So,
I think what we're seeing too, having, kind of a insight to what's going on with a lot of the hosts that are in the local Atlanta market, I think there's a combination, like you pointed out, with the regulatory environment. There's been quite a few of folks that have kind of, not renewed their leases, or they've kind of converted from short-term to long-term. And so that's definitely cut down on, the supply and probably, as we've pointed out, not been in as much growth mode as it has been in the States as a whole.
Right.
Yeah.
And you can certainly see that. Whereas if we go back to the U.S., we can definitely see a diminishing trend. Here we've actually gone negative. We did that this year, so our supply has been retreating. There's that big May decrease that was concerning to me. However, since we've talked, the 3 months since we last met, we've been trying to get that back up to positive, and we've really narrowed it down a lot in August, which is nice. It's a sign that I think some more people are staying in the market, and also that more people are interested in Atlanta and the things that we've got to offer here. So that's supply. Go ahead.
And sorry, that's a huge insight, I think, as you mentioned, the folks that have kind of been sticking it out, like myself and a lot of others, the writing on the wall here seems to be that, the supply is definitely easing up a little bit as far as growth goes. And so it kind of frees it up a little bit for the folks that have stuck it out in terms of, being a part of that going forward, where there's not going to be as many competing listings, essentially.
Oh yeah, absolutely. We had a lot of people getting in that market in 2022, and some of them may have been dilettantes, perhaps. Not truly interested in hospitality, but just trying to get that quick buck. So U.S. and in Atlanta in particular, we're easing up the supply growth. It's not as madcap as it was back in 2022. We even have a little bit of a reduction in this year, but yeah, to your point, for the people that have stuck it out, that's going to help performance. It's going to make it a little bit easier to take the same demand and produce a higher occupancy. So what has demand been doing?
Me too, Bram. I'm sorry to keep jumping in here, but go back one more time to the other chart. Because as I'm looking at this stuff, a picture paints 1,000 words, basically. The other thing, like you're pointing out in 2022, with a lot of the hosts that hadn't taken hospitality serious, that's really resulted in a lot of the bad rep and bad PR that short-term rentals and Airbnb have received, with folks that have been complaining about cleaning fees, complaining about not being treated a certain way. And so, clearly it shows how many new folks were in the market in 2022 that had a direct impact on a lot of that negative feedback. So, once again, I think the data speaks directly to what we've been experiencing in the market for sure.
Yeah, I still get those kind of articles every once in a while on my Google feed. I'm like, that's old stuff, Nobody's the cleaning fees. It's all included. Nobody's trying to rip anyone off of cleaning fees these days. Those people have already left the market.
Yeah. Sorry. So you could go to the next one.
So that's good for the overall health, I think. Now, nationally, demand, it was weak in 23, and you can see that here. If you felt like your demand wasn't really stepping up to the plate in 2023, you weren't alone. All across the U.S., we saw demand not quite reach its potential. You see the booking. That means, the people were booking for future dates. So the booking growth was quite a bit stronger than the demand growth. And that's because, booking is a forward indicator. So, when people were booking for 2023, June of 2023, it was earlier on in the year for a lot of these folks. So this booking was indicating that we were going to start having better performance as time went on. And that is what happened in 2024. January was a stinker of a month because we had a cold snap and no snow for some reason. So that was, calamitous for the nation as a whole. Nobody wanted to go out, and you couldn't even ski if you liked the cold. But we did pick it up in February. We had a calendar shift in April that it moved Easter and spring break. But since then, you can see we have some pretty consistent high gains. And August was a killer month. We had another calendar shift. 2 of the Labor Day weekend days fell in August this year, so that helped out a little bit as well. But, very, very very good signs that demand is responding to the economic climate. People are they're doing well. I don't know if you've looked at the data recently. We've just updated the GDP figures. They've actually gone up every single time that we had an update before or a revision to numbers. It seems like things were getting worse, but we finally found out that GDP has been doing better than we thought for the last year or so. And you can kind of see that. I think people knew that and they were traveling more. Now, if we look to Atlanta, you brace yourselves here. We saw a very, very bad 2023 as far as demand goes. A lot of negative territory here, these blue lines. And luckily, that has not been the case this year. So again, we had that weak April because of the calendar shift. And then, January is not such a big month in Atlanta for tourism anyway. But as we're moving into the summer and people are starting to get out more, they're going on their summer breaks, you can see those demand numbers starting to pick up positive. And we had a very strong June. We had a very strong August as well, above 5% growth, which is a tremendous improvement from last year. So it has been a difficult time, but we're starting to see that demand and booking are picking up. Now, when I said that, I could point this out too. When I said that booking is a forward indicator, and these high green bars on the left side of this graph meant we were going to get high blue bars on the right side. Not so much the case with Atlanta, and that's because Atlanta, out of all the markets that I've looked at, has a special feature, and that I'm sure that all your viewers right now know about. There's incredibly short lead times, so that booking and demand almost happen at the same time. So that's why this one has a different character.
So, Bram, for folks that may be seeing this data for the first time, can you give us a little bit of an explanation on how you guys are determining demand and how you're determining booking nights?
Sure. Yeah, that's what we do. Is since we scrape every listing every day, we can see everybody's calendar and their availability. And when that availability when it drops, we have an algorithm that's got 17 metrics that it looks at. And it's very good, particularly for shorter term stays. It struggles a little bit with sort of medium and long term stays, but it's very accurate with the short term stays. And what it can do is it can say, well, all right, they've dropped the availability. That means it's a reservation. In this case over here, it's because they were taking it off of the market. Over here they were blocking it for a few weeks for personal use. But these are the actual reservations, and we can see the length of those, and we can see when those are made, and that's the booking, and we can see for what dates they are made, and that's the demand.
Got it.
We try to double check. We get about 1 million listings too that give us their information directly, and we always try to cross-reference that to try to improve our accuracy as best we can. But generally it gives pretty good results. But I think that the big takeaway though, for anybody working in the Atlanta market is that, if 2023 was difficult, but hold on, because it's going to get better. It's already getting better, and we're expecting it to improve further as well. If you put those two together, supply and demand, and you get the occupancy, the national story has been the same as the Atlanta story. Is we had 2021 incredible performance, ratcheted down. 2023 was kind of a low point in the cycle, and we've been sort of in recovery mode in 2024. Now, something I've noticed with Atlanta, also another special characteristic of the market, is that it feels the market swings more acutely than the nation as a whole. So when things are doing well, Atlanta booms, and when things are doing badly, we're slowing down a little bit. Atlanta does a little bit worse than the nation as a whole. So that is bad in the bad times, but hopefully, like I said, we've got good times going forward. So as a nation, we increased the occupancy 0.2% this year over last year. But Atlanta, we were up 5% compared to last year. And that's a combination of, I think, one, that we're starting to come out of this and we're going to be having good performance, but also that 2023 was a tough year for Atlanta. But if you also look, August, and this is exciting to me, August's occupancy was higher than in 2019. So to your point, Rich, we've had very slow supply growth in Atlanta, and this might start paying dividends to the folks that have stuck it out, because now we're actually seeing super normal occupancy, even though the rest of the nation is still well below the 2019 levels. If you look over here, it's not in excess of the 2019 levels. It's in excess of the 2023 levels, but it's still not making that sort of benchmark. Here in Atlanta, on the other hand, our August occupancy was up and up higher than it was from pre-pandemic. So I'm hoping that this trend continues. We're going to see if it does. And I do have some forward-looking data. But before I get into that, I do also want to talk about rate, ADR. That's an important source of RevPAR as well. And what has rate been doing? The rate story has been a little bit different for Atlanta and the U.S. as a whole. As you can see here, last year, rates went down on average. And rates are the magenta line here. That's the actual rates. But something that we've got, and this says inflation, but that is incorrect. It's supposed to be the repeat rent index, as it says there. But this is the U.S. as a whole. So what is this yellow line, and why is that different than average rate? This is something that Jamie Lane and Mark Moreno, they cooked up, and it's a really smart idea. But what it does is it takes the mix shift out of it. Essentially, what we're doing is only looking at rate changes for properties that have existed in the market for some time. So sometimes rates will change because new people come into the market and they charge a different amount than the existing folks do. But this yellow line tries to sort of capture what are the people that are staying in the market, that have been in the market, what are they doing? So taking mix shift out of it. So we did have negative rate on average last year, but that was generally because, and only because we had a lot of cheaper entrants into the market. People sort of trying to undercut the existing inventory as they entered. And that's been a trend since about 2022. It has ceased, and we've seen that supply slow down. And now the supply that's still coming on board that, remains, the supply growth that remains is much more aligned with the market in general for the U.S. Now, what's it like for Atlanta? Well, because Atlanta has had, some big ups and downs with its supply and lately more down than up, it has kind of a slightly different story. As you can see here, the repeat rent index is in fact a little bit lower than the ADR. So the new product that is coming in, such as it is higher priced, and the people that are leaving are the lowest price, and that's flipped from the national. So the ADR growth is actually higher than the repeat rent index. So that's kind of an interesting development, I guess. We're nationwide.
That is very interesting, because if I had to venture a guess, I would have guessed it the other way around. That folks that are entering the market for the first time that aren't that familiar with pricing were underpricing, but now and the folks that have been there for a while have a better sense of what the true value and pricing methodology should be. So it's actually quite eye-opening that it's the reverse here, that you've got folks that have been in the market for a long time. And I think a lot of hosts that I work with have recognized, it's a constant balancing act with pricing, right?
Mm-hmm.
And revenue management, right? So you can definitely get higher occupancy, but at what cost? Your nightly rates are going to need to go down to accomplish that in some cases. And I think a lot of experienced hosts have just accepted that reality. And in exchange for having a unit sitting empty, they're potentially pricing lower than usual. And that's what this data is showing here. So very interesting.
Right. And something else that I'm thinking too is that because property, values have gone up in Atlanta, if you had a low price property, it's generating a small amount of revenue, you might have sold and gotten out. It's only when you start getting to the more expensive, more luxury properties that you're going to be having a big enough margin that doesn't make any sense. So that might be another element that we're seeing here, but it is the opposite of the nation as a whole, where we are seeing low priced entrance. Here we're seeing either low priced exit or maybe even high priced entrance compared to the people that have been in the market. So it's a sort of interesting feature of the Atlanta market I've noticed. Here's a little forward-looking stuff, and then I'm going to get into the submarkets, because the other thing about Atlanta is you've got a bunch of different areas. It's a huge geographic area that Atlanta covers, and there are lots of different kinds of submarkets in there. And something else to point out before I get too much into this is that Atlanta, because of those lead times, we have to interpret these pacing data a little bit differently. So pacing data is the on-the-books demand that we had at the end of August this year versus the on-the-books demand that we had at the end of August last year. So current year, blue, prior year is green. And if we got more stuff on the books this year than we did last year, then we're happy about that. We're pacing up. Now we are pacing down for September, and that's the case nationally and also in Atlanta. But there was that calendar shift as well, so we got to remember, keep that in mind. August was so strong because we did borrow those 2 Labor Day weekend days from September. But nationally, people are really pumped about the shoulder season and also holiday travel. We can see that the pacing is way up, especially for December, up about 16%, which is pretty impressive. It drops off in January and February, but I don't know how many people are really making plans for January and February right now. And once you get out that far, the pacing data becomes less useful. But in any case, yeah, we're expecting pretty good holiday travel across the U.S. Now, here is that lead time stuff, Rich. I want to tell you, this is crazy. I've looked at a lot of different markets, and these are median lead times. It says average right there, but I'm sorry, that's not correct. This is a median. So half of the people are going to take less time than this to book, and the other half are going to take more. And then the person right there in the middle is going to be taking this dark blue line. So it dipped down really low in the pandemic, 5 days on median. So half of the people that are going to be staying in Atlanta in 2020 were waiting till 5 days before the date to book.
Yeah.
But that was a pandemic. But we go forward to today, and wow, it's 12 days, which is not a lot longer. Especially when you think about, before the pandemic, we were out there at 25, 30 days, a month. That's pretty good. Here, you're going to have to start changing your schedule. I got to get back and I got to clean this place because I've got this person that's just wants to stay there. But in any case, this is a very, very low lead time. So, I salute all of the Atlanta operators, but this also means that Atlanta pacing data is going to be incredibly unreliable. Because again, this is sort of the on the books demand, and we don't really have anything on the books, or we don't even have half of the stuff on the books until 12 days before the date. So you can imagine for essentially anything that's not 1 month in the future, it's really not going to be terribly accurate. But you can see here that because it has gone down from last year, last year around this time, let's take a look. We were at around 17 days. So 17 to 12 days, it's only 5 days difference, but as a percentage, that's pretty significant. Right. And that's I think where a lot of this is coming from. So you can see it's slightly negative in some of these places. It's not until you get way out until like February that you can see a big positive, and that February data is very unreliable anyway. But again, I think this is not speaking to necessarily weakness in the shoulder season for Atlanta. Rather, it's speaking directly to that lead time, which makes it almost impossible to predict exactly what's going to happen using pacing data. So that is an additional difficulty of people operating in the market. All right.
Makes sense.
So apologies, I can't give a better forward look than that, but we can look at some of the existing trends in some of the submarkets. Something else that's important to note is that things are very different depending on where you're at. So, for instance, I just looked at central, the sort of core of Atlanta, the central part of it, and you've got sort of the northern part with Buckhead there, Lindbergh. Part of Midtown, the West Midtown section, which we kind of partial off, it's somewhat different in character. In Brookwood, these are the heavy hitters in the North Central. That's what I'm calling that area, and they have got the most listings. But if you look here at that time when the regulations were announced, that's when you start to see dramatic decreases in this supply. Even though those regulations were never strictly enforced, or they're certainly not enforced all the way to the letter of the law, there is still, I think, just that uncertainty just really drove people away from that particular part of the market. On the other hand, if you look at more the downtown area, Midtown proper, you look at the Atlanta University Center, that's over in Vine City over in the west a little bit, Inman Park area, the heavy hitters of the south part of the central part of the city, they didn't even notice that there was regulations. They just kept on growing supply. It's about the same pace that they were before. There's a little bit of dip you can see in 2024, I think maybe in response to some of the performance woes we had in 23. But it's not clear to me that any of this is because of regulatory uncertainty. And again, that part has started to grow, whereas the north has started to shrink. So even though our supply in Atlanta has been pretty level, in some areas it's blowing up. In other areas it's diminishing, it's shrinking.
Yeah, so, it does seem on the South Central, yes, it looks a lot more aggressive in the last 24 months or so, but you definitely do see an immediate dip in the early part of 2020 when they announced and formalized that totally non-investor friendly ordinance. So there is a dip there, right, in the South Central as well, in terms of.
Well, there's a lot of stuff going on in 2020.
Yeah, right. No, that's fair. That's fair. But yeah, it's an interesting dynamic in terms of the different markets. I mean, the Midtown Atlanta area, at that time, I think I had about 32 units in Midtown Atlanta, right when they voted that ordinance in. And so, I know a lot of other folks in that market as well. And so, that market performs quite well. And so I think it's a tougher sell for somebody to, sit on the sidelines when there's some uncertainty, when you've got something that's a lot more consistent. So I think that comes into play as well. Right.
Yeah, the consistency is key. Consistency and certainty. Those are the two kind of really, really important parts, or the columns that hold up investment. Really, the performance for these, and this is kind of interesting too, because I've taken these areas and I've actually looked at the performance. So, and I want to refine this graph a little bit more, maybe get in a little bit more detail here. But you can see that the top line is that excuse me, that green line, I should say, the green line is the South Central, so the downtown, Midtown proper, the sort of Atlanta University, that's the green line. It starts out higher. The blue line is that north. It's the Buckhead area up there, and Brookwood, etc. And the orange is the difference. So they start out. There's a pretty big difference in RevPAR. It's about $20. And you can see too, the northern submarkets were just trying their damnedest to get that down, and they were actually able to reverse it. They were able to get on top by the beginning of 2020. And then, as you said, well, the pandemic hit, and also that the ordinance was ratified or voted in, and that trend that they had worked so long on started to reverse, and we see that gap widened again to even above $20, so to all-time highs. It still is pretty high. We're starting to see that once again go down, but to me, that difference in the performance and how it reacted to those shocks, the trend, the long-term trend was for those two to meet, or even the northern markets to have a slightly higher RevPAR. But when the market got shook up, it reset, and now they're starting to come down a little bit, but they've got a long way to go to sort of narrow that gap. So it's an interesting, I think it's an interesting dynamic that they've got. So maybe the South has got more consistent performance, perhaps, as it's been sort of going along, and the North may be more reactive to some of these shocks. Certainly Definitely. In the supply, but perhaps also too in the performance.
Yeah, real quick too, Bram, if you could give us a quick, brief explanation on RevPAR, just so folks that, maybe seeing this for the first time, get a good explanation of what that means.
Well, we're already going over time, so what I wanted to do is combine occupancy and ADR, and I could have had a bunch of different graphs, but what we can do is also use RevPAR, which combines the two. Essentially, you multiply your occupancy by your average daily rate, and that's going to be RevPAR. In other words, for every listing night, how much on average you can expect to get in revenue. That's RevPAR. Does that work?
Yeah, and it's basically a better measurement, because you could have an ADR of $100, or you could have an ADR of $200. But when you look at an ADR, a RevPAR of $100, just to put it in perspective, that means you've generated $3,000 for the month, right? So it's looking at the actual revenue generated for the entire month. So the hotel industry has been using that measurement forever, and so it's a more descriptive method in determining what was your income, what was your actual gross revenue versus, like you pointed out, the difference between occupancy and nightly rate.
And
so Bram, don't feel rushed. Feel free. We usually do keep these to about 30 minutes, but I only get you for once a quarter, so feel free to take your time and let's dig in here. This is important stuff.
Sure. Yeah, I'm not too worried. I was just trying to explain. I was trying to condense two slides into one. But to that point, I've had people actually ask me, I really want to maximize my occupancy. How can I do that? And tell them, maximizing your occupancy is very, very easy. You find some people off the street, you tell them that you can live in your place for free, and then you've got 100% occupancy.
Right. So but forget about your night, and you have a zero nightly rate, which 100% occupancy, zero nightly rate, right? So it doesn't pay the bills.
You do not want to maximize occupancy. You want to go after RevPAR is really what you want to do.
Exactly. That's a good representation of describing what it is, for sure.
And I would be very remiss, and we've talked a lot about the sort of the central core of the city, but I also want to check out the burbs as well. I live in Marietta, so I wanted to see how the burbs are doing as far as their available listing. And I thought this was interesting as well because, Marietta, it used to be the biggest of the outlying sort of suburban submarkets, but that has changed because at Lawrenceville, it just comes screaming up from behind. It was at third place and now is the top market. And I think it's because the trend for a little bit of for a while, when you see that explosive growth there in Lawrenceville, the trend right there was affordability. So everybody was looking for affordability. And you can see over here, the RevPAR in Lawrenceville is quite a bit lower because the ADR there is lower. Marietta had, I guess, a premium product or maybe a premium property taxes, who knows? But in any case, their RevPAR was very, very high, and they weren't able to grow the available listings as quickly as Lawrenceville was. Something else that's kind of been interesting is to see that Lithonia has been sort of dropping its performance a little bit faster. All these other suburbs have been able to recover since 2022 and are starting to go back up, starting to increase that performance through ADR increases, through occupancy. Lithonia and to some extent the Stone Mountain area as well adjoining it have been struggling a little bit more to try to get the demand to come back to those areas. So who knows, maybe they'll come out with a new laser show that'll draw everyone to the area. But right now it looks like the ADRs, the occupancies have not been supporting a RevPAR in that suburb. So something else too, Alpharetta has really come up as far as the RevPAR. And the development that has been occurring in Alpharetta in that area, and just the traffic tells the whole story if you've been driving around in that area. But it's been an area of intense interest, and I think that is helping to drive up that RevPAR a lot.
Yeah, they've had a lot of corporate offices move in there. You've got the live work play concept with Avalon.
Yes.
And yeah, so there's been a lot of growth up there. But this is a very enlightening look-see in terms of the local markets. I wouldn't have thought that Lawrenceville would have been that big of a performer, especially compared to Marietta and Alpharetta in terms of the growth in RevPAR. But it makes sense, as you point out. It's more expensive to buy housing in Marietta than it is in Lawrenceville.
Right. Got to pass that cost on to the consumer as well.
Definitely. Very enlightening. Same thing with Lithonia. The housing cost there is fairly low, and it's interesting that they're kind of struggling with RevPAR as well.
Yeah, that may be more, I think, of a demand issue. Trying to get the folks to go out to Lithonia is maybe a little bit more difficult. There's so many great places in Atlanta to go, so you really have to work hard to try to stick out and make your individual listing, really speak to people. So
yeah.
I think in the future they'll be able to find a way, but right now they have been slipping in their placement just a bit.
Definitely.
Right. And that's my take so far on the Atlanta market. Just the data. I hope I didn't make things too dry. I'd love to have graphs, and I have a lot of graphs, but I try to keep them to the two basic kinds: the ones that go up and the ones that go down. And we all prefer the ones that go up, so we'll try to have as many of those as possible.
Yeah, most definitely. That was very enlightening. I appreciate what you did there with the sub markets. It's very interesting to see some of the differences. I mean, that's actionable data. A lot of us as investors are looking at opportunities in all of those sub markets, and to have a good understanding of the historical performance and kind of what direction it's heading in is critical. So that was definitely very informative. For those of you guys watching and then also watching the replay, if you'd like to get a copy of Bram's slides that he presented, he's making it available to Bnb investing members. Feel free to send me a private message or a DM on Facebook Messenger, and I'd be happy to send that over to you. If you're watching right now, throw it in the comments that you would like a copy. Just put copy in the comments, and I will get that over to you guys. And so Bram, and would love to hear I know some of your graphs and charts here did talk a little bit about looking forward. But I'd like to hear from you just kind of what's the outlook for going into next year. What are you seeing in the market as far as opportunity in the short-term rental market? And we are, as we touched in the early part of your presentation, there are some early indications of improvement year over year. Surprisingly, in most markets, including Atlanta, we have higher nightly rates and higher occupancies than we did the year before. But would love to hear your perspective, what you're seeing and what you think we're going to end up with going into next year and into the future.
Yeah, well, I'm pretty optimistic about this next year. One of the reasons for that is that 2023, in retrospect, was so hard in so many ways. I remember talking with Jamie, I think in January of 23, and looking at the economy and just not knowing what to do. The inflation rate was through the roof. The labor market was holding strong, but wages were not keeping up with inflation at all. And that is always a very, very bad time for the consumer, because, the groceries, the rent, the gas, everything was sort of putting a big crimp on everyone's budget. And travel is unfortunately one of the things that people will cut if they are pressed. Even though I think, it's not really a luxury. I think travel is a necessity to keep sane in this kind of world. You got to get out there and travel. But as I said, we've done some revisions lately on the GDP, and they've been very exciting. We've increased the GDP growth, so we've had a little bit more livelier economy than we had thought this year, and that's going to be improving in the future. The saving rate also went up, so people are actually saving more this last year than we had thought, which is great. So that means that their balance sheets are going to look a little bit better. Now they can start looking again at travel as something that they can not only do, but maybe do more often as well. And taking trips, you can take, a big trip, but you can also take smaller trips and more of them. And then Atlanta is a really great destination to do that because it's very accessible. It's a great drive-to market and a lot of great cultural stuff there. So, that gives me some hope. Also, the labor market's still holding strong. Our unemployment rate is it's inched up a little bit, but it's still well below 5%. That's what they called natural unemployment when I was a kid. I think it's gone down a little bit since then, but it's still a very good unemployment rate. And we've just had, of course, the big interest rate cuts, which are going to help capital investment. It's going to help the job market. It's going to start stimulating new investment. But it's probably not going to be making our supply go crazy, at least for this next year, because it takes a little while for that to fully transmit to the mortgage markets. It takes a little bit of time for people to figure that out. It takes a little bit of time to start planning to have a short-term rental. So all of this stuff is kind of on a lag. And we think the interest rate is going to be diminishing more slowly than it increased. And it's probably not going to go as low as it was in 21 when it was just about zero. So I think all of these things, what they're doing is pointing to a more lively economy where people are making more money. Inflation is now back down to where it needs to be. It's below 3%, and it's very, very quickly heading to 2%. The only thing keeping it up is some calculations that they're doing to get the rental value for people that are living in their own homes, which, as I think all of us know, is it can be difficult to really predict that well.
Definitely.
So I'm really optimistic about that, and so we've got demand sort of having a lot of strength, a little bit more confidence, and a little bit more strength, and we're still having that supply come down. And what that says to me is that unit level performance is going to increase. We're going to get pricing power and occupancy, and that is always welcome news for the short-term rental industry.
Love it, love it, love it. It's always good to hear good news after the last couple of years of doom and gloom. So happy to hear that.
Right. Oh, and and Rich, I know that you've invited me to come. I'm going to tell everybody you invited me to come back in December, so now you can't you can't welch on that one. And I'm really excited to see, because we don't really have very good forward-looking pacing data on Atlanta, but I don't think we're going to be seeing negative year-over-year demand change. I think, again, that's an artifact of just that short lead time. So I'm really excited to come back in December and see what happens to demand in the shoulder season and during the holidays.
Awesome. Definitely. Well, thanks so much for your time today, Bram, and thanks for agreeing to come back in December. We love having your quarterly updates. It kind of gives us a finger on the pulse and an insight into what's happening in the market. So we really appreciate that. Thanks, everybody, for tuning in this week. And if you are interested in kind of learning how to grow a scalable business, you're ready to take some action, feel free to reach out to me as well on Facebook Messenger and schedule a quick call. We do have clients that we work with that want to scale a business and kind of help them along the way to get there quicker. So thanks again, Bram. Really appreciate it. And thanks, everybody. We'll see you again next week.
Thanks, Rich. Always a pleasure.
Thanks for jumping on the BNB Investing Podcast this week. Please click on the subscribe and like button below. For more trainings, property tours, and content, you can join my BNB Investing Facebook group by clicking below. If you are ready to grow your short-term rental portfolio and maximize your monthly income, you can click on the link below to schedule a quick strategy call with Rich or someone from his team to see how we can help or point you in the right direction. Stay tuned for our next episode and hope to see you on the BNB Investing Group podcast.